point, you probably have a pretty good understanding of bonds, their history, kind of the little mechanics of how they work. But did you know that the institutions almost every single day are creating products and services they are selling to the retail public, marking them up tremendously, and pawning those off on you? What if you could take that same basic strategy and create those products yourself? Well, you can, and here to help me break it all down for you is Bill Addiss. Bill, thank you so much for joining us.
Pleasure to be here. Thank you.
Thank you. With these bond products, I see it every day in the industry. Somebody trying to sell me an annuity or a bond product, and I always get bad vibes and feelings because of the prices associated with it. So I was talking to you, and you said, you know what, we can make these ourselves. Walk us through the basics of how the average person can create these products and services that are heralded by the financial institutions and do it themselves.
And there is that opportunity. You know, in the institutional world, we're going to talk about a strategy in just a moment that is called immunizing your portfolio.
Ooh.
I know it sounds impressive. For the retail investor, we know it simply as the bond ladder. And this is a strategy that can be relatively easily implemented by the retail investor with just a little bit of homework and understanding of the strategy. And under the ladder, what we're going to do is, let's assume you have looking to invest in bonds for income for your portfolio, or maybe you're addressing a retirement need 10 years from now. Okay. You want to fund that opportunity. Rather than just go out and buy a block of 10-year maturity bonds, what this strategy would propose instead is you create a sequence of different maturities leading up to 10 years. So for example, I might take about 20% of my money and invest it in a 2-year maturity bond.
Right.
I'll then take 20% invested at 4 years, another 20% at 6 years, 20% at 8 years, and then the final 20% at that 10-year. And by creating this staggering ladder of maturities, we're creating for ourselves a number of different opportunities as a result. Opportunity number one is, think about the income coming off that portfolio. By having these 5 different bonds, you have a steady stream of income coming in that can be reinvested at the new and prevailing interest rates. And in the bond world, we call that reinvestment risk. So now, because let's be honest, in the real world, one of 2 things is going to happen over the next 10 years. Either interest rates are going up or interest rates are going down.
Pretty sure you're right.
I'll feel comfortable with that. I'll guarantee you they're not going to stay the same for the next 10 years.
Pretty sure.
So under this strategy, think about it. If interest rates are going down, you now have locked up some of your income for as long as the next 10 years at the old prevailing high rate. Concurrently, though, if interest rates do go higher, you now have the opportunity to take that income coming in off your portfolio and reinvest it at the new and prevailing interest rate. And we call this reinvestment risk. So that's opportunity number one for this ladder. But the other opportunity is regarding the maturity of the bonds themselves. Think of this like a conveyor belt. Every 2 years, you have bonds coming due, maturing, and at maturity, you get back your $1,000. You're then able to take that $1,000 of principal coming due and roll it back out to the 10-year maturity, creating almost like this conveyor belt of maturities.
The next rung.
Almost like an annuity. And by doing that, once again, you have that reinvestment opportunity. If interest rates go down, well, yes, but you have the higher interest rates at least for the next 6, 8 years. But if interest rates go higher, you've got a reinvestment opportunity at the higher interest rate. The point is here, we're not trying to hit a home run. Right. This is not a home run strategy. This is a strategy that is trying to minimize your impact to those fluctuations in interest rates. And by creating this rolling sequence, you're going to immunize and keep consistent the levels of income you have, rather than be subject to all of these ups and downs.
That's what I want to get to, because I think somebody watching might go, well, wait a minute, if I want to buy 10 years worth of bonds, I'll just buy all of it at once at 10 years, and then I don't have to do anything in that intermediate time. I got 10 years, I can just sit on my heels and do nothing. The problem there is, if you do buy that one block, let's say it matures in 10 years, you will have these market cycles. And we don't know whether they're going to go up or down. What we're pretty sure is they're not going to stay exactly the same. We might actually see, from a market timing perspective, we could see rates go much, much higher. We just don't know. So if you split that 10 years up into 5-year chunks, so you got 2, 2, 2, 2, 2. Now we start to spread that risk around. I think that's the key. And as you mentioned, this is not hitting home run. I'm trying to minimize those wild fluctuations. And the average person is going to go, well, I want that huge spike up. Yeah, you do. So do I. So does Bill. But we don't want the big spike down. So spreading it out allows you to achieve those goals. What type of investment vehicles would we look at to buy in this specific bond ladder strategy?
And this is where we also can diversify our risk. Because as we were talking earlier, we were talking about diversifying relative to interest rate risk and the maturities. But there's also a discussion to be had about credit risk. So if you are a very conservative investor, very risk averse, you might want to look at something like treasuries, where by buying this basket of treasuries, you've got what we call the risk-free rate, as we know, and that is going to be the lowest yielding because it has the less credit risk to the assets you're buying. Now, if you're willing to take a little bit more risk, you could do this strategy with certificates of deposit, bank CDs.
Okay, which isn't really a bond.
They're not technically a bond, but they look, smell, and act like a bond.
It's a fairly safe investment that gets you maybe a smidgen more.
And that's it. Because they are backed by a government agency, certificates of deposit, they offer a little bit more yield than a traditional treasury themselves, so we could look at certificates of deposit as an asset for this strategy. For those investors willing to take even more risk, we could look at products like corporate bonds or municipal bonds, where you have a range of different credit exposures there. You could have investment grade, the highest quality, and you could have the ever-popular junk bonds, and you're truly a speculator.
Like, wow, I'm getting 30% rate,
and taking risk accordingly.
Massive risk. Let me ask this, because I think some people watching this might be going, wow, this seems relatively simple. I want to go be involved with this. Should there be kind of a linear path, or meaning do they mix? Like, for example, if I split it into 10 years, and my first 2 years, I'm going to buy some treasuries. And year 4, that's CDs. Year 6, well, I'm going to buy some junk bonds. Should there be that kind of fluctuation, or should you have kind of, okay, I'm going to have a junk bond ladder, here's my kind of CD ladder, treasury bill ladder? Should you keep them kind of the same?
I think the recommendation would probably be, or the observation would be, if you have a certain level of comfort relative to credit risk, it's going to be linear across the spectrum. Meaning, if I'm a very conservative investor, I'm going to be conservative for 2 years as well as for 6, 8, or 10. So you'd be in treasuries. If you are willing to go more risk, then do it across the maturity spectrum. So the baskets do tend to be somewhat homogeneous. Not to say they have to be, but relative to your individual risk tolerance, that'll probably be pretty much standard across the maturity spectrum.
It's just one of those things that pops in my head, because I could see someone going, well, now I'm going to buy this. And it's like, well, you're mixing the objectives almost.
That's exactly right.
Now, you've gone through a bunch of different assets here, from treasury bills and CDs and junk. Where do people go and buy those specific bonds?
And this is where the individual investor does have to do a little bit more homework. For example, in the case of treasuries, if you're the very risk-averse, safety-conscious, we've talked about a program, and I've written about a program in articles here for Online Academy about Treasury Direct, which is an opportunity for the individual investor to buy treasuries directly from the government at all the maturity spectrums that they offer, and getting the same price and yield as the institutional investor is getting, and literally paying no fee.
And that actually is huge, because it's funny, because you're going, well, the rates of return might not be great. No fee does actually make a big difference.
Absolutely. So for the risk averse, the Treasury Direct program, I think, makes a lot of sense. For those people looking at CDs, now here again, different banks offer different rates of certificates of deposit. So you have to do a little bit of shopping and literally shop bank to bank as to what rates they're offering at different maturities. Corporates and municipals get a little bit more difficult because that market is completely over the counter, as we've discussed. There's no one place to go to get a
And that's kind of like you kind of have to go to a broker to have them sell you their portfolio. And again, I think that what's important there also is you do need to shop around, because one broker might have this basket, and another one has a different basket, so shop around.
Absolutely. You know, look at the maturities you're interested in, what yields are available at what bonds through that broker, and do some shopping. That's the important point.
Let's look at our second strategy here. You mentioned this one called the bond barbell. How does this work? I'm feeling a little deprived in the barbell category.
Yeah, for interest rates. The barbell is also a strategy that is used institutionally as well as retail. The barbell, think of it like a simplified ladder.
Okay.
Where we're only going to have 2 maturities, 2 data points. So for example, again, if I'm funding a retirement in 10 years or my child's college education, I might take 50% of my money and put it in short-term cash, short maturity instruments. It's going to be very safe, not a lot of volatility to that.
Not a lot of earnings either.
Not a lot of earnings in today's market either. That's the safety end of it. And then I might take the other 50% and invest it in the much longer maturity, which is going to give me interest rate exposure, interest rate sensitivity. And the concept that we're talking about here, without getting into the math of it, is a concept called duration, which we've mentioned. And I could prove to you mathematically that given the volatility of interest rates that we've talked about will happen going up or down, the barbell will actually outperform just buying one block of bonds. There is a duration weighting to this. Yes, you're going to take a lot of risk out here, but it's weighted by the 50% here at the short end. So the barbell, think of it as a simplified ladder, but mathematically it will usually outperform just buying that one block of bonds, irrespective of whether rates go up or down.
And I think that the key here with that barbell, and even with the ladder, is time. So if you're doing this for a year, you know, it's probably not going to beat just buying the individual bonds. But if this is a 5, 10, 15, 20, 30, 40-year type of thing that you're doing, you will beat, because you're eliminating all those fluctuations that just buying one batch of bonds could expose you to. So that you remove that volatility or minimize that volatility, and now all of a sudden you can generate somewhat consistent returns, which, come on, let's be honest, that's what the goal of these products is supposed to do.
Absolutely. It's not the home run strategy.
All right, well, we've got two very interesting strategies that we looked at here. We've got the bond ladder, which says let's split our investment up over 5 different 2-year blocks. And we'll buy bonds accordingly. You pick the bonds, try to keep them homogenous, meaning if you're going to buy treasuries in year 2, buy treasuries in year 10. If you're going to buy junk in year 2, buy junk in year 10. At that 2-year maturity, roll it over. New rung of the ladder forms, and you keep rolling this on as long as you want. The other one is the barbell, where you have a 50-50 split of your investment. Some of it's going to be in short term, like CDs or cash or treasuries. The other part going to be a little bit riskier. You know, do you go into municipals? Do you go into corporate? Do you go into junk? That's up to you. But over time, those low risk and high risk will balance out, and you'll get, in theory, a nice rate of return over the course of time and generate that income stream that we're looking for. If you'd like to know more about these specific bond topics, Bill Addiss has a bunch of articles and videos over at otacademy.com. I'd encourage you to check those out. So, Bill, thanks so much for joining us.
Always a pleasure. Thank you very much.
Pleasure. Guys, in future, we'll have many more articles and many more videos, so check out otacademy.com. Take care.